removing, or we just look at how we've been looking at it, determined on the PE of how it jumps back and forth, or is those significant jumps when
Well, just bring your
Mhm.
SSG back up. We'll see if we find an irrelevant number.
Okay.
Bring your SSG back up and look at page 2. So look at your earnings per share.
Hmm.
They're steadily rising, so I do not see an anomalous or abnormal EPS in those.
Okay.
Um, when you're looking at earnings per share. At the PEs, when the PEs were 20s and now the high P's are 51, I'm not going to use that 51 and 46 in the average. Those are too high. Companies only growing 11, 12% a year. But that's
So
what
would I
that
take
article
out
says.
these two?
Yeah. But even the 10-year average down to 32, I mean,
Hmm.
that's probably reasonable. 32, maybe 30.
Yeah.
But I wouldn't use 40. I think you're initially using 42 or
Yes,
something.
I did. I
Yeah.
did.
So anyway, okay.
But
Any
it's also
questions
within the
from?
buy zone. You did say it's overvalued at this moment.
Yeah.
Yeah, I wanted to pull that part out, and that's the part where it gets a little tricky for me. It's
Any
the
question? Yeah. Any questions from the audience as we try to move on? So Valencia, it's a continuously learning experience. I learned a lot at Bink just this past month. And this article is actually, I would encourage everybody to read it because you'll understand why people use as their final stock selection guide more conservative numbers. Because when things like, for example, for example, Google, Taiwan Semiconductor, when they surprise on the upside, which they do, wow, because you bought it at a really reasonable price. Or Netflix, we bought it at a reasonable price. And you get these super good numbers. Well, that's all good. I want to be surprised like by Alphabet instead of being surprised by Vital Farms. You're still going to have those. I mean, I had two terrible stocks last year I had to sell myself personally that I made big mistakes. I freely admit it. Lululemon, you've heard me talk about that. I made a huge mistake on that. So anyway, uh, does Group 4 have the education?
Oh, are we?
Group 4? Um, y'all have it or not? Well, I do have an education I can give because it was what I was going to give, but I'll go through it quickly. This is about the article. So this is going to take me about 5 minutes to go through, and I'd be glad to answer any questions. And I'd be glad to send this PowerPoint to anybody. So can you see my screen now, everybody?
yes.
Okay. So I said before we go further, we're in this club now 6 years, guys. And we all should be capable of developing a quality stock selection guide using the Better Investor principles. So I made up a slide yesterday, which basically says your sales estimates can come from three sources: Value Line, Morningstar's on the stock selection guide, the front page, and the sentiment, which is in the stock selection guide. Those should be your three sources for sales. Now, sources of earnings, we're just going through this. Value Line, Morningstar on the front page of the SSG, FinViz, which we just showed how to do it, Seeking Alpha and Zacks, we just showed, Sentiments on the SSG, CFRA on the broker, and the preferred procedure. I think we all should come with at least 4 or 5 sources of earnings estimates when you're presenting a stock. Just put it on a slide, and so the club can look where you're using the estimates from, because I think that's very educational. Now, as far as the article is concerned, they basically say there are 6 judgments, actually 7, on the SSG. And this article is written by Nancy Isaacs, long-term BI 2001, and Albert Lawyer redid it this month. I'm sorry, there's a typo there. So what are your judgments? Growth in sales, growth in earnings, IPE, low PE, low earnings, low price, and high price. That's the judgments we're making on every single time we do an SSG. So what does an experience, in other words, somebody who's an old fart who's got a lot of scars and on his investing past, what does those person do? Projecting sales growth, quite frankly, is the easiest to project. It's the top line of the income summary. Use relevant date, remove your outliers. That's when you're looking at each year going forward. Remember, sales growth decreases as the company ages. In general, the tech stocks are not following this because their sales growth is actually increasing, but most companies like Cintas, it slowly decreases. Use the most recent 1 to 3 years of data for sales growth. Look at quarterly data and consider capping your sales growth at 20%. This is directly from the article, guys. I highly suggest you look at the article. Predicting earnings per share growth. Once again, eliminate anomalous years, just like Valencia was just saying. Think twice before earnings per share growth faster than sales growth. Use the preferred procedure as a reality check. Remember, analyst projections are aggressive in the growth, so you may want to lower them a little bit, just like we were just talking about. How do we find the projected high PE? Well, remove your externally high PEs that appear anomalous. Consider using the lowest 5 of the high PEs of the last 10 years. Reduce the high PE if you see your EPS growth is going down. And new SSG users tend to use 5 years of historical high PE, which is often too high. This just from the article. Once again, I suggest you read it. Projecting low PE. Once again, remove anomalous high low PEs. Consider using the lowest 5 of the last 10 years PEs. Lower your PE when sales and earnings or growth are going down. Once again, new SSG users tend to use the 5-year historical low PE, which are often too high. And consider capping your low PE at the EPS growth rate. So if it's growing like 12% a year, you may consider using low PE of 12. That seems awful low. I'm telling you what's in this article. This is not Randy Buzz. This is directly from Better Investing. Projecting low earnings per share. Generally, as we know, default the stock's most recent trailing earnings per share as the projected low earnings per share. We all know that. That's really nothing new. Projecting low price, general default, as you know, is use the low PE times the trailing 12 months earnings per share. Now, this morning, when I looked into our portfolio, there were 2 downside ratios, actually 3, which were invalid. And that's because the current price was less than the low price. So when the current price is near or below the present price, your low price recommendation, use the 80% of current price. So let's say your stock is currently at $80 per share and you had used $82 as your low price. Well, you need to lower that to 82% times $82 times 80%. So you get it down to about $65, $66. And projecting high price, this is the best case scenario. Be careful to use reasonable high P's and reasonably high earnings per share. Tendency for the newer people is to project a high price to be too ambitious. So anyway, that's directly from the magazine. When I read it, it reminded me of a lot of mistakes that I've made in the past by not doing what these authors describe. And that's what we're going through this meeting. And that's why I wanted to make sure we discuss this at some point. Are there any questions, or did you read the magazine?
Yes. Can you share this in the chat with everybody?
I'll go ahead and send an email to everybody. I email it to everybody. But it's in the magazine, page 29, May. So, Jennifer, how can I help you?
My question was answered. Thanks.
Okay, okay, good. So. The other stock we were going to present is, I was going to present Lilly. So this grew out, and Carmen and I were at presentation by David Gardner. He's one of the two brothers who started the Motley Fool in the late 90s. And in this presentation, he discussed meeting what we'll call the Harley guy. And in his presentation, he's talking to a guy in the bar like 1998 or 99. The guy's a big motorcycle guy. He's like probably an attorney or accountant or doctor because they cost you a lot. And he goes, "Oh, stocks are terrible. I lose every time." And he gives the story that initially they bought a mutual fund, which went down 25 or 30%. And so he sold that. And he gave it to a stockbroker, which lost another 25 or 30%. And he's telling Dave Gardner, "You don't know what you're talking about. Stocks always go down." So Dave turns to him. He goes, "Why didn't you buy Harley, your motorcycle?" Guy goes, "Well, that's just a motorcycle I love." He goes, "Why didn't you look at Harley the stock, which was a wonderful stock in the 1990s, because the boomer generation was buying Harleys left and right, no longer. But the story was buy something you know." So what do I know about? Well, I'm a doctor. Some things I know, sometimes I don't know. Dave Ramsey says the dumbest occupation as far as finances is doctors. And I 100% completely agree. That's why I joined Better Investing in 1989, because listen to all the idiots in the doctor's dining room. So anyway, what do I know? Well, how about obesity? 40% of the American population, adults, is obese. 30% are overweight. So 70% of the American adults, way too much. And you all know about these new GLP-1 drugs. Lilly has the leading drug. So let's just go quickly through the most recent earnings. I will first start, before I go through that, let me show you FinViz. This is what got my attention. The current PE is 35, 34. Now it's on the high side. But since the earnings are so much better, the next 12 months PE is 21. And the stock market's forward PE is also 21. So that really got my attention. And that's why I actually looked at this stock. So this is from the quarterly report from just a few days ago, earnings call. This is their, let me make a slideshow. So this is their earnings.
Can you show the screen, Rhonda?
Oh, I
Sure.
apologize. I have not done that. I thought I did, but I did not. So let me see if I can do it again. Here we go. Can you see it now? The Lilly?
Yeah.
Okay.
Yes.
So let's go to slideshow from current slide. Now, for some reason, it doesn't want to do that for me. So there's the graph. It shows. Zoom slideshow. Let's go there. For some reason. Anyway. Okay, can you see that now? So Lilly currently has 60% of the sale of the GLP-1 drugs in America. Is anybody seeing that now? Is that showing up?
Yes, we do.
Okay. Their national GLP-1 drugs, Lilly currently has 53%, and it's going up. Let's go back. This is their pipeline. Now, Lilly is making a ton of money right now, and they're able to buy drugs from other companies. And look at all these drugs in phase 3, which is the last phase before the drugs go to the FDA. I mean, they seem to have like 30, 40 drugs that they're looking forward. Actually, different drugs for different reasons. They're going forward. So it appears to be they have a good pipeline, which is what you always look in pharmaceutical companies. Here's their key events. In 2026, their oral drug started being sold about a month ago for obesity. And this is talking about the regulatory submissions they expect this year. Here's the income statement. First quarter, their revenue, you hear the sales were up 56% this past quarter. Wow. Wow. Earnings per share were up even better, 170%. That kind of got my eye. So these drugs, I think, are currently being used by 10 to 12% of the adult population, but they expect it to grow. I wouldn't be surprised if in America in the next 5 years, 20%, maybe 30% of the obese people are taking these drugs. That wouldn't surprise me the slightest bit. They are unbelievably good. And you don't need to have an operation for gastric stapling to lose weight these days. You can take these medications. And for the reference, my son is currently on these medications. So, and we see this in my surgical thing where a lot of patients are very obese, and my current partners who are still operating are putting patients on these drugs before they operate on them to get their weight down to a reasonable weight. So currently, US is about, I guess, about 60% of sales. Europe's, that's probably about 15 to 20%. There's Japan, there's China. Capital allocation, since they're making so much money, they spent, first quarter, they spent $2.9 billion on research and development because they have the money. Another $2.3 billion in capital investments, like building more factories to make these drugs, because they're making a ton of money right now. Their guidance, they raised their guidance a couple weeks ago. Previously, they were expecting $33 to $35 per share earnings. They expect that to be now $35 to $37. They just raised their guidance recently. So as a summary of the first quarter, excellent revenue, excellent earnings, and they expect the rest of the year to be good. Now, you can see, this is what I like to see, the price of the stock going up over the last few years. On the value line, they expect sales for the next 5 years to go up 17% per year and earnings 26%, which I think is a little bit on the high side. But anyway, value line, which is generally conservative, expecting great results, this company. So let's look at the bad stuff, bulls and bears. This is from Morningstar. Let's look at the bears. The risk to success of one of the drugs remains high because of bottlenecks. This is the most important one right here, right here. The drug made by the other company, their drug is going off patent next year. There will be a generic. Although these are proteins, and it's not going to be like a pill that'll go drop 90% in price, but their prices are going to come down. And I think that's the major risk to Lilly if the generics start to impede their market. So they say competition to weight loss, Zepbound, which is Lilly drug, could significantly increase because not only the generics, but 2 or 3 other companies are coming up with new GLP-1 drugs. Currently, Lilly's drug is clearly the best. There's just nobody would disagree with that. This is from FinViz, which I showed you. They're expecting earnings in the next 5 years to grow 28%, which is very similar to Value Line. So when I make up a stock selection guide for the club, I look at sales from these 3 sources, Morningstar, Value Line, and the sentiment, just like I talked about, and the earnings per share, just like I'm so glad we went through a Valencia stock. The only one, CFRA, you have to get from a broker. All these other ones, most of them get off directly from Better Investing, except for, as you know, CFRA you have to get from a broker, as we said. and the sentiment. I mean, all these other ones, Finviz, Morningstar, Seeking Alpha, Value Line, Saks, and Sentiment are all on your SSG, just like Valencia just showed us. So earnings per share, I average at 23%, sales at 19%. So when I updated my stock selection guide, let's see if I can find that in here. Here we go. So let's go to Lilly. Y'all seen Lilly now, SSG? So as I said, earnings were up 169% last quarter, sales up 55%. My sales I held at 19%. Earnings, which you said, well, I went conservative. They said like 27, 20. I used 21. Pre-tax profit has been going up 19, 28, 39 due to these GLP-1 drugs. Return on equity is outstanding at 86%. Debt is on the high side. So remember, we're looking at 33% or less. This is 61. That's a downside, but it's been going down the last few quarters, in the past few years, but that's a downside. So that's a risk. The valuation, current PE is 35. 5-year average PE is 39. So the relative value is probably about 85. The high PE, if you look at all these high PEs, the 5-year average is 49. I used 35. So I brought it down significantly. It gave me a high price of $2,555. It's currently selling at $1,000. Full disclosure, I bought it a week ago at $950. The low price, select the low price. I use an average low PE, so way down compared to what we had on the before 20, and the current earnings per share last 12 months is 28, can be $563. And so that put me in the buy range, but in the higher part of the buy range on this conservative one. And using the average PE, they expected to grow 16% per year the next 5 years, and high PE is about 22%. So let me summarize. This company is the best company currently at GLP-1, and their sales and earnings profits are growing like a weed. Now, there's going to be competition, generic competition, and other new competition. I know Roche is coming out with a drug. I've heard Amgen's coming out of drug. So there may be competition, and this may not work out. But those are the pluses and minuses in this drug. Anyway, that's my presentation. Any questions?
No question, but I found it very informative and learned quite a lot. So thank you very much.
Yeah, when I was at Better Investing, I was talking to one of the senior people there, and he came up to me. Good, he knows me. I met him one time before, and he goes, "What do you think about the GLP-1 drugs?" I said, "Literally, Mark, I was a volunteer. I was a hall monitor, shall we say, to get into bank. The 500 people going. I was for a couple of times. I had to stand at the door to make sure you're a Better Investing member to get in. I said I wanted to have a shot of GLP-1 drugs in a box. When somebody looks 100 pounds overweight, I want to give them a shot on the way in." Teasing them, but I'm telling you, these are really good medications. And this is, as a physician, this is the leading medical problem, healthcare problem in America today. It's not smoking anymore, because smoking has come down dramatically. It's not drinking, because the young population are drinking nearly as much as, let's say, the boomer population did. It's obesity is the major health problem in America. It just is right now. But anyway, it may be too high priced. It may have competition, but that's the bull and bear issue. So, we come to our time. It's afternoon, but we can go a few more minutes. We can discuss. So we have money. As we were showing earlier. I'm sorry, I didn't share that. I have to stop share. One of these days I'll learn how to do this. We have currently basically $2,200 in cash. We can decide if we want to sell Vital Farms or not. We can sell any of these stocks.
Randall, can
Yes.
you bring up the PER report? Not the PER report, the summary report.
I'd be glad to. I have to stop this share. Share. Oh, no, yeah. So let's go to the summary report, which I think is an excellent way of looking, so I'm glad she brought it up. So this is South Florida Model Club. Here's the summary report. And a good way of looking at that is to look at stocks that projected total return is on the high side.
If I remember correctly, we determined that Visa and Microsoft were the current PE was lower than the average PE, and they were on the buy and give a good return.
Mm-hmm.
Well, Lily is not here, but if I'm looking at your
Select the PERT.
the average PE is lower than the current PE is lower than the average, so they will be in the same category.
Yes, I would agree with you.
And then it will be a return of 22%, which is higher than Visa and Microsoft. Now looking at the percentage, Visa is very high, so I would not increase that. But Microsoft is low in terms of percentage in the portfolio. I know Lily just was presented, but you have the expertise of the stock, and the return is good. We agree that Vital Farm should be out of the portfolio. We don't want to lose more money. And I don't remember what decision was taken with US Line, but we have cash in the account. So we can do things. What do you think?
I think you're right.
We haven't
If-
made a decision about US Limes yet, but
We
is
haven't
that up for
debated.
discussion, Randall?
Well, I would suggest, I'm just saying the better investing principles are you don't sell it the first bad quarter, which is, as we looked at the data on US Line, the other core orders are fine until this report. So following better investor principles, you would not make a decision until you see the next quarterly report. That's what BI principles say. That's not what Randy Buss says. That's what BI says. So the way I would look at that personally is, I follow better investing principles. And it's just what I do. And it is once I finally learned them really good, I'm telling you, my life's a lot better. And Ione, I'm sure, would probably say the same thing.
I say that I think we forgot Netflix, because wasn't Netflix also in the buy?
Yeah, Netflix was also in that
Yeah.
list. You're right.
There you go. Right there. Yeah, I agree. We have several stocks in the buy. If we sell Vital Farms, we'll have about $2,800. If we don't sell it, we have $2,200. And
What about if we did both? US Limes, can we talk about US Limes so we can, because we have, thank you for that information. My apologies for interrupting.
no, go ahead, dear.
I just want to make sure that we have in between that we know what our purchasing power is. And so if we eliminate, or if we're going to just make a decision about US Limes, which clearly might mean that we do need to have a discussion about it, and we can see if we have more purchasing power for more Microsoft and Netflix. And at this point, I think those are only two members.
Well, I
Now,
mean, the
the
one
pro-
thing,
The problem with that is your diversification is going to be a problem. Just to say,
right, that's what I
yeah,
said.
let's look at diversification. We already have 32% in tech, and Alphabet adds another 22%, which is a techie company, and Netflix is another 5. So you've got 27 plus 33. So you're basically at 60% is in a techie type of section. That's just what that shows.
Well,
And
what Carmen was saying at the last meeting, which is had a point, is in regards to, which is trying to make an argument for heavy tech or heavy communications, is that the S&P 5, if we, one of the methods of BI is to follow the S&P 500, and the S&P 500 right now is also heavy tech, heavy communications.
you're right. I think it's about 50-ish. It's heavy. You're absolutely right. Is that good or bad? But I'm saying,
So how about
correct.
if we sell Vital Farms? I think if the sales in US Lime are declining, at least for the last 2 or 3 quarters, and also the earnings per share. So we might have to cut it sooner than later, and then increase Microsoft because it's just 4%, at least 1% more. And I will take Lily into, even though our healthcare sectors, well, if I remember correctly, the health sector in the SP 500 is over 10, 12%. So our allocations are decreasing. Before they were more than 4% each. So I will add Lily, definitely. I will increase Microsoft, sell Vital Farms, and at least US Lime is 4%. If you want to cut it to half, that will be fine, because that's part of the basic materials. And when we agree to follow the SP 500 weighted average portfolio, we decided that any company that it was no more than 5% will not invest it, and material was one of them. And we were making a lot, we have been making money with this company, I believe. So maybe those are the things that you can manipulate, add something at a lower price, make it grow, and then sell it.
I completely agree with you, Carmen. And I want to make sure you guys
Okay.
understand. It's not me trying to make a decision whether the club's going to buy or sell. The club has bought things I haven't liked, but that's the club. I don't want to make it, Randy. Whatever you guys want to do, you want to put a motion together, that's fine. It's what we'll do.
Do we want to take one motion at a time?
Why don't we start with my original motion for Vital Farms?
Okay. So the motion is to sell all Vital Farms. Do we have a second for that motion?
I second the motion to sell all Vital Farms.
Okay, let's take a vote. We've discussed this. All those in favor of selling Vital Farms?
Aye.
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 Say aye.
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 Now, I want to emphasize, it's what a rule of 5 stock. 20% of your stocks are not going to do like you expect, although they have beautiful SSGs. That's that stock. That's all it's doing. So good. We'll sell Vital Farms. Let's go forward. So that gives us about $2,800. We can, as Carmen suggests, if she wants to trim US Lime, we can do that. We can sell US Lime, or we can just, buy Microsoft and Lilly or something else. So there's several stocks we have, and I think we should stay pretty much fully invested. Myself, that's my recommendation.
I have another motion to sell US Lime.
Okay. Do we have a second? You want
I
to talk about
second the
selling,
motion. I second the motion.
selling all of US Lime, Chris?
Yes, all of US
Okay.
Lime.
Okay. Is there any further discussion? All those in favor of selling US Lime, please say aye.
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 All those opposed? Nay. I would say no. But I think we only have 3 votes for it. We need more than votes than that. We need other people to come off mute and.
I
Aye,
don't
okay.
say anything.
But
Okay.
also read the chat.
Yeah, so we got chats. We got 1, 2, 3 in the
Aye.
chat.
I'm in favor.
Okay, great. I just want to make sure we have a majority. That's all I'm asking. So that's a majority. We will sell all of our US line. And that's going to give us another $2,500. So what are we up to? About $5,300 now. Okay. Any more motions?
Mm-mm.
How about buying some Microsoft?
Yes.
Since when the price went down
Yes.
and we just have 4%.
Okay.
Can
We
we
have a
still put,
second.
what,
I second it.
what,
Okay.
did she make the motion?
Yes.
How many
Oh.
shares, Carmen, do you want to buy? It's about $410 a share. And there's $5,300.
How much we wanted to have it to? Now it's 4% of the portfolio, and any others, the minimum we have is 7% with Taiwan. I don't think 3% will be too much, but I don't know.
Well, you
No
could just
more than-
double it with
How about we just-
$2,100. But
Yeah.
double it.
I guess no more than $2,000.
Yeah.
Okay. Well, we need a number. I mean,
Oh.
there's if you want to double it, you're talking about buying 5 shares essentially.
Okay, I don't have that information. Let me see if I have it.
I know it's about
We own
$400 a
5
share.
shares. We own 5 shares, so.
We could buy 5 more shares.
That
and
sounds
that would
good.
Be about 2,100,
So
so.
Chris, I assume that's a second from you.
Yes, that's a second to buy 5 shares of Microsoft.
I'm waiting for open discussion.
Okay, open discussion.
Well, I just want to know, what does that look like for the portfolio? And I think Carmen had mentioned it, but I just want to make sure that we are leveraging it correctly.
We
And
are
does anyone? Okay.
we're raising our tech diversification. So,
Mhm.
I mean, the downside is if tech does poorly, the portfolio do poorly, but if tech does well, which it has been.
Were we
It'll
going
do
to
well.
consider any of Netflix?
Well, we're going to have plenty of money left after this. We're still going to
Okay.
have $3,000 left after this.
No worries. Thank you.
Okay. Any other discussion?
Lily,
Well, let's start with Microsoft. We have a motion. All those in favor of buying 5 shares of Microsoft at market, please come off and say aye.
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 I,
Okay. All those opposed?
Aye.
So we're going to buy 5 shares of Microsoft.
Mm, yeah.
Does anybody want to buy Lilly or Netflix
Lily.
or Lilly? Okay. Well, Lily's at $1,000
Netflix.
and Netflix. Okay, we can do both. This is
Can we?
Oh,
Do we have
I'm
enough
sorry.
for
sure
both?
we have $3,000, so we could buy
But
like
Lily,
one share.
isn't Lily very expensive right now?
It's $1,000 a share. We can buy 1 share
You could buy.
and buy.
I would rather just buy 3 shares and be done.
Okay, well, I mean that's something for the club to the sky.
No.
Okay.
But we can look at, but I don't know if we have enough time to look at what that looks like in terms of the next 3 to 5 years and using the principles. But yes, but I thank you, Christian. But yeah, no.
My argument is based on the fact that we're so heavy on communications and tech, and then
Mhm.
healthcare we're heavy too, but not as heavy. So I would just and we just bought more Microsoft, so I would say if we're gonna get heavy, let's get heavy on another sector versus continue on the communications and
Randall, can you put the summary report just to see the upside down ratios and the,
Yes, please.
Here you go.
for Netflix, we have there,
Okay, where?
6.
Leave that.
Netflix, 26. Okay.
it would be nice if we could do a comparison between, I know they're different in sectors and industries, but a comparison of Lilly and Netflix and help us make that decision.
Lily and Netflix.
Okay, let's do that. There you go. There's your stock comparison guide.
Can
Now,
you add the industry average for it, one at a
Oh.
time? Let's put it that way.
okay, tell me how, industry
That
average.
way, there. Choose
Okay,
one,
drug manufacturers.
yeah. Take
Oh.
off all the greens. I don't know if those probably you have the. Well, so starting with the manufacturer, it seems that Netflix is doing much better than the industry from what I see in 5-year sales, everything, and even the okay, and then choose the other one.
Well, I tried to
And-
do that. Honestly, I don't know how
There,
to.
there it is, there it is. I'm sorry.
I know, but how do you bring it up? How do you bring it up?
What do you mean?
I'm trying to bring it up.
It seems that you
Oh,
have,
it's over here. Drug man, is this it? No.
yes,
Yes, that's
those
it.
are the numbers. Those are the numbers. Those are the industry.
But
What
that's
she's
the
saying
drug-
is first to compare.
But that's for Eli, right? For
Yeah, it's for Lily.
Lily.
Right. That's what
Oh,
she's
huh?
saying is first compare Lilly with the average of the drug manufacturers, the sector it's in, and then secondly, separately compare Netflix with the entertainment industry averages, and that way you can you got to one by one is what she's saying.
Okay, I'm gonna throw you a curveball. At the company that does the portfolio reviews, they had the guy doing the pharmaceuticals, and he said he wouldn't buy. He goes, healthcare is a bad industry now. But also, this is the same group that told me to short Tesla 4 years ago. So I literally they did. I swear to God they did. So I'm going to take whatever they say with a grain of salt. Is all I'm saying. Because if I would have not listened to them, I'd probably have a lot more money in my pocket. I didn't
Well-
short Tesla, but I didn't buy it.
Well,
is-
it's got it's showing right there. Netflix has got a 23.7 return versus a projected versus a 22. I mean, I know that's not a lot, but it's still more. So there you go. I mean, if Netflix is going to give us projected to give us a better return, that's our decision. I mean, that's what I would do.
But do you still want to do Lily? Do you do one share of Lily?
I would just do with the little that's left. I'd do one or the others. With my opinion, that's my recommendation. But it's up to the club.
Well, it depends on if we go Lily and we do the 1% and we can get 20% on 22% on that one share, opposed to getting 23.7% on our portfolio to what we've invested already.
Or remember, it's projected. It's not a guarantee we're going to get. If
Yes.
I wish it was a guarantee we were going to get 23, but it's just projected.
That part, yes, sir.
Yeah, and
I
those
agree.
numbers are almost the same. There, I mean, honestly, 22 and 23, I don't find that a big difference. Honestly,
So what do we
not a
do?
significant difference.
So if we went with Lily's projection, 22%, if we got 22% on based upon that one share opposed to getting more shares of Netflix, what would you choose at our price point or when at our execution?
What's the because we're gonna okay, the current price of Netflix is 87 versus 1,000. So you're just gonna get more shares, and it's just
Yes, and more return on that share. So, but again,
No,
let's
don't look at
it.
that. I mean,
It's-
you got no, because they may split Lily stock 10 to 1 sometime this year, and then you're going to have the stock at $100 a share.
Yes, and we can go get it then when it's on sale.
It won't be on sale. It's the same
Well,
price.
I like to think of it as on sale, Randall, only
No,
because I
when you
love a
split a
stock.
stock, it's the same price.
I
because the
know.
earnings are split 10 times.
But it's psychological for people that purchase.
well.
What did I tell you this morning? Be like Spock,
Yes.
dear. Be like Spock. No emotions.
No emotion.
How
I'm
about-
working on it. I'm working
Okay.
on it, Randall.
Okay, let's make some decisions here. It's
So
almost
how
12:30.
about 2 shares of Lily and whatever money is left in Netflix?
Do we have a second for that?
Second.
Okay. So we're talking about 2 shares of Lily, and what's left is into Netflix. Okay.
Well, the split sold me. So let's have a discussion. Yes, I agree. And a yes, of course, I will say yes. So when you put the vote out, I'm going to say yes. I mean, we'll have maybe if they do 5-1 or maybe even 10-1. Okay.
Thank you, Miss Spock. Uh, so, any more discussion? All those in favor of buying 2 shares of Lilly and the remaining cash in a Netflix, say aye. Aye.
Aye.
I,
Right.
All those opposed? Okay. First, I want to apologize to Carmen. I was trying to move the meeting on, but I should not have used that tone of voice. So Carmen, please accept my apology. And so we can have guests who are still with us. Will please come off mute and tell us what you liked or you didn't like.
Well, before you do that, I
Okay.
apologize that if I kind of incited anything. And I just wanted to also kind of throw out that I'm here in California celebrating my daughter's graduation from USC, and I'm just very excited. So I have, look, I was going to be off an hour ago so I can go hang out with her. But thank you all, and I appreciate you all. You are lifesavers on so many levels that gives me incitement into who I really am, and which I love doing this stuff. So thank
Well,
you.
congratulations to your daughter.
Congratulations. That's great. That's wonderful for your daughter. And it speaks for being a great mother if your daughter's doing so well.
Thank you.
It really does. So are there any guests still on? Our next meeting is on June 20th at 10 a.m. Anybody else want to talk about anything else? I will send both of my PowerPoints to Lily and on the agenda and everything. I'll send it to everybody in the club, but I tell you, my email is having trouble with about a half a dozen of you. So if you wish to it and you don't get it in the next hour or two, just send me another email with your email address. I'll try it again. But that happened twice yesterday to me. So I thought this is a great meeting because I think when you have disagreements and we can go forward with better investing principles, I think we'll do much better. I really do. It brings us that's what the learning experience. That's what BI is all about, is learning. And we all are trying to learn. No matter if you joined last month or you're an old fart and you joined literally 36 years ago. We're all learning every month from better investing. So thank you all and have a wonderful weekend.